Okay, welcome everybody, and welcome to Miami, to the Economic Club of Miami. We're pleased to host Federal Reserve Board Governor Lisa D. Cook tonight here. I also want to mention before we introduce her, if you're interested in being part of the club, the Economic Club of Miami and what we're doing, be sure to visit our website, econclubmiami.org. We are growing like crazy. We started with about 35 members 3 years ago and now 350. And growing almost every day. So we encourage you to join the club if you're not yet a member. And also I want to just mention this club was one of the co-founders of the club is our founding chairman, John Hartley, who will be interviewing Governor Cook after she delivers remarks. John, in addition to being the founding board chairman of the Economic Club of Miami, he's currently a candidate for PhD in economics at Stanford University and a research fellow at the Foundation for Research on Equal Opportunity. Previously, he worked for Goldman Sachs Asset Management in both client portfolio management and risk management roles. He's also served in various government roles at the World Bank, the U.S. Congress Joint Economic Committee, the Federal Reserve Bank of New York, and the Federal Reserve Bank of Chicago. He's been a regular economics contributor for Forbes and the Huffington Post, and has had other writings appear in the Wall Street Journal, the New York Times, and USA Today, among many other outlets. John has also appeared on CNBC, Fox Business, Fox News, and Bloomberg, and was named to the 2017 Forbes 30 Under 30 Law and Policy list and the 2017 Wharton 40 Under 40 list, and is a World Economic Global Shaper, and of course, our founding chairman. So thank you, John. Of course, tonight we're joined by somebody who you guys are all waiting to hear from, and that is Federal Reserve Board Governor Lisa D. Cook, who took office as a member of the Board of Governors of the Federal Reserve System on May 23rd, 2022, to fill an unexpired term ending January 31st, 2024. She was reappointed to the board on September 8th, 2023, and sworn in on September 13th, 2023, for a term ending January 31st, 2038. She's going to be there a little while. Prior to her appointment to the board, Dr. Cook was a professor of economics and international relations at Michigan State University. From 2018 to 2021, she was director of the American Economic Association Summer Training Program, and she was also a research associate at the National Bureau of Economic Research. Previously, Dr. Cook was on the faculty of Harvard University's Kennedy School of Government. During her time at Harvard, Dr. Cook also served as deputy director for Africa Research at the Center for International Development. Before then, she was a national fellow at Stanford University. I actually found out recently that her and John had a few connections at Stanford in common, so I'll have to see if they explore some of that. From 2011 to 2012, Dr. Cook served as a senior economist on the Council of Economic Advisors under President Barack Obama. From 2000 to 2001, she served as a senior advisor on finance and development in the U.S. Department of Treasury's Office of International Affairs. Dr. Cook received a BA in philosophy from Spelman College. As a Marshall Scholar, she received a second BA in philosophy, politics, and economics from Oxford University. She earned a PhD in economics as well from the University of Cal Berkeley. So I just want to thank Dr. Cook for being here and welcome her to the podium here at the Economic Club of Miami.
Thank you so much. Thank you. Thank you, Francisco, for that kind introduction, and many thanks to the Economic Club of Miami for the opportunity to speak with you today. It is wonderful to see firsthand the vibrant and growing South Florida economy. I was sitting over here saying, of course, this economic club is only 3 years old. And of course, it went from 30 members to 300 members. Everything you all touch has that feeling. So I'm not surprised. The Miami region's unemployment rate is below the national average, and consumers in Florida have been among the country's most resilient. I am happy to have the opportunity to engage with all of you who are central to that dynamism. I'm especially glad to have the chance to update you on my economic outlook shortly after the FOMC's first meeting of the year. As always, I am focused on achieving the dual mandate of maximum employment and stable prices given to us by Congress. This evening, I will discuss both parts of that mandate and give you my view on how the economy is evolving. I will then share some thoughts about the apparent disconnect between sentiment and activity before discussing implications for monetary policy. Broadly, I see the U.S. economy as continuing to be resilient, with recent data indicating that growth in the second half of 2025 was even stronger than previously forecast. Inflation appears to have stalled stubbornly above our 2% goal, while at the same time the labor market appears to have stabilized in recent months. While the overall condition of the economy is solid, I am carefully watching sentiment, delinquencies, and other indicators that show a worsening outlook for low and moderate income or LMI households. Allow me to start with inflation. While some data are delayed because of last year's government shutdown, we have a good sense of inflation's trajectory. Based on the latest available data, it is estimated that the Personal Consumption Expenditures Price Index rose 2.9% for 12 months ending in December, still above our 2% target. Core inflation, which excludes the volatile food and energy categories, was estimated to be 3% at the end of last year. Those readings indicate that progress on inflation essentially stalled in 2025. I have long discussed how important it is to return inflation to our target. Such a plateau is frustrating after seeing significant disinflation in the preceding few years. To understand why inflation leveled off in 2025, I find it instructive to look at the subcomponents. The disinflationary trend has continued for housing services, an expected outcome as cooling and new tenant rents flow through to overall shelter prices. Inflation for non-housing services has also eased, consistent with a less tight labor market. Conversely, when looking at core goods prices, we have seen a notable uptick in inflation. That primarily reflects an increase in tariffs last year on a wide variety of imported goods. With anchored inflation expectations, it is anticipated that tariff increases should only lead to a one-time price rise. That raises the likelihood that the recent disinflationary trend could resume once tariff effects recede into the rearview mirror. However, much uncertainty remains. The future direction of tariff policy is unclear, and even when tariff levels are settled, uncertainty remains with respect to how long it will take for that price rise to be complete and whether it will take hold in inflation expectations. I would note that measures of short-run inflation expectations have fallen since last spring, and longer-run inflation expectation measures have been stable. Longer inflation measures remain above target, the greater the probability the longer inflation remains above target, the greater the probability that higher inflation will become entrenched in expectations. With respect to the labor market, data available through the end of last year suggests that the labor market stabilized after having softened through 2024 and earlier in 2025. In December, the unemployment rate was 4.4%. While up from the cyclical trough, the rate was little changed over the second half of 2025 and remained relatively low. To put 4.4% in perspective, consider the average unemployment rate for the 50 years preceding the pandemic, which was 6.2%. Meanwhile, layoffs remain low, and new applications for unemployment benefits have held steady for several years. The number of available jobs relative to unemployed workers seeking work is just below 1. This reading is historically consistent with a solid labor market, although it is appreciably down from a few years ago when the labor market was considerably tighter. Risks to the labor market persist. Individuals who report working part-time for economic reasons as a share of employment jumped at the end of 2025 after gradually moving higher over the past few years. Furthermore, job creation has slowed. Non-farm payrolls rose by only 50,000 jobs each in November and December, after declining in October as a result of a substantial decline in federal government employment. This low payroll growth does not necessarily indicate a weakening labor market, as it is likely connected to the fall in supply of workers due to immigration policies and underlying demographics. However, it does suggest that the low unemployment rate is not driven by strong labor demand. Instead, labor demand has eased roughly in line with the fall in labor supply. Overall, these readings indicate to me that the labor market is roughly in balance, but I am highly attentive to developments, knowing it can quickly shift. Looking ahead, as I have discussed in several speeches, I see the continued proliferation of AI is likely to have a significant effect on the labor market and on the economy. Growing evidence shows that AI has the power to significantly boost productivity. Better productivity gains would support economic output and allow real wages to increase. I also see AI accelerating the generation of ideas, which could lead to the creation of new products, businesses, and jobs. Nonetheless, I'm aware that job destruction may precede job creation, such that the unemployment rate might rise as the economic transitions, causing hardship for many workers and their families. I am concerned that there is a dynamic inconsistency problem, such that there could be a mismatch between the arrival of cost of AI to AI investment and the arrival of benefits, including higher productivity that is non-inflationary. The overall economy is solid. GDP rose at 4.4% in the third quarter of 2025, the most recent period for data that are available for the third quarter of 2025. That marked the second straight quarter of strong growth after a first quarter downturn. The third quarter's gain was driven by consumer spending, which broadly remains highly resilient, as well as an increase in net exports, which is a volatile category. Fourth quarter growth readings will be somewhat constrained by the effects of the federal government shutdown, which should unwind in the current quarter. For all of 2025, I estimate that the economy grew just above 2%, and I see a similar rate of growth being maintained this year. Recent strong overall growth likely masks a challenging situation facing many families, particularly LMI households. For example, youth and Black unemployment rates, both of which tend to be more cyclical than overall unemployment, have risen since last spring. The deteriorating labor market experienced by these two groups mirrors other emerging strains in some households' financial health and balance sheets. Among these households, I have observed large increases in delinquencies and see some other evidence that their spending has stagnated when compared to the robust growth that we see in other higher income components. This divergence is sometimes called a two-speed or K-shaped economy, in which the well-off are doing well while vulnerable households are not. I think about this two-speed or K-shaped economy when I attempt to take signal from various sentiment readings. Consumer sentiment by many measures is lower than one would expect in a solid economy, and perceptions of job availability have continued to worsen. Outreach calls I have had with business and labor leaders, as well as with members of various communities and organizations, similarly suggest a dissatisfaction with the economy, and worsening one, especially among vulnerable households. Typically, weak sentiment indicators are associated with a downturn in the economy and the labor market. However, there is reason to approach them differently at this time. I find it important to try to understand what is driving that discrepancy to ensure that I am not putting too little weight on what are called softer indicators. I've come to the view that there are four main reasons households are reporting low sentiment. First, households are worse off relative to recent history. Though the economy is solid now, it has clearly softened in the past year or two when it was running hot. It is natural that households would compare to their near past when assessing the economy's health and their prospects. Second, the introduction of AI has raised uncertainty about the job market. Even Americans who see the benefits of AI can also be concerned about the labor market transition and wonder whether in coming years jobs will be available for themselves and their families. Third, decades-long structural changes that present challenges for today's middle-class families exist. Most notably, housing costs have increased sharply for both home buyers and renters and have far surpassed wage gains in almost every region of the country. Moreover, the cost of education, health care, elder care, and child care has risen by more than wages. Household debt has also risen, and intergenerational mobility has declined. I conjecture that the growing pains of these trends may not be felt by American households linearly over time, but rather that they interact with other macroeconomic trends, such that they become especially painful at times, including in recent years. For instance, I think the age distribution of our workforce may make these trends more salient now, with young adults competing for housing and jobs with older, wealthier baby boomers. Finally, the fourth reason I will point to as an explanation for weak sentiment is a high inflation experience not just today, but over the past 5 years. This reason also interacts with the long-standing trends I just mentioned. The recent bout of inflation that would have called attention to the corrosive rise in real prices of housing, child care, elder care, and education that occurred over decades. In summary, the reasons for low sentiment are real and are deeply concerning. But they do not, in my view, reveal a signal about increased slack that we can tackle with our typical demand-side monetary policy. In fact, for the part of households' concerns related to the pain of inflation, the best we can do in our roles is to ensure that inflation returns and stays at target. When considering the proper stance of monetary policy, I see risks to both parts of our dual mandate. Inflation remains persistently above 2%, and there is considerable uncertainty about when tariff effects will recede. While the unemployment rate has shown signs of stabilization, the lack of dynamism in the labor market likely makes it susceptible to downside shocks. Overall, uncertainty about the outlook remains elevated, although I believe the labor market will continue to be supported by the 3 rate cuts last year. At this time, I see risks as tilted toward higher inflation. As a result, I supported the FOMC's decision to hold the policy rate steady at our meeting earlier this year. As I described, there is an argument for being optimistic about the path of inflation, but until I see stronger evidence that inflation is moving sustainably back down to target, that is where my focus will be in the absence of unexpected changes in the labor market. As I have said before, but cannot repeat too many times, the FOMC's firm commitment to its inflation mandate is imperative. After nearly 5 years of above-target inflation, it is essential that we maintain our credibility by returning to a disinflationary path and achieving our target in the relatively near future. At the height of the recent bout of high inflation, we promised that we would return to target. And it was this promise that kept inflation expectations anchored and allowed us to see the sharp disinflation from 2022 through 2024. If we were to lose credibility, the cost may not be immediately felt, but it would be resoundingly and painfully felt when we needed it the most, in an inflation crisis such as the one we experienced 3 years ago. As I have laid out, I remain optimistic that inflation will soon return to a path that gets us to our target, that the labor market is stabilizing, and that sustainable growth lies ahead. My optimism is tempered with caution. That is why I remain vigilant in studying a wide range of incoming information so that I can pursue the best policy to achieve our dual mandate goals. My future policy decisions will be guided by incoming data, my economic outlook, and the evolving balance of risks. And finally, before I conclude, I want to briefly acknowledge the outpouring of support I received from so many friends, current and former colleagues, and many others in recent weeks. It is humbling, and I am deeply appreciative. I will not have anything more to say today about recent legal proceedings. I can say that it is an honor to serve on the Board of Governors of the Federal Reserve System. I will continue to carry out my sworn duties in that role on behalf of the American people. I look forward to discussing my economic outlook and the work of the Fed with you all today. Thank you again to the Economic Club of Miami for this opportunity. I look forward to your questions.
Thank you so much, Governor Cook, for that excellent outlook on the economy and that excellent speech. We're very happy to have you here in Miami, and really, it's an honor anytime a Fed governor comes down to visit us here. So we're grateful for your presence here, and we've got a good set of questions here, and some of these are curated from the audience. And I just want to dive straight into it, and I think I want to start with Kevin Warsh. I think that the topic of the hour, I think, as it relates to the Fed, we know that that Kevin is the president's nominee to become chair of the Federal Reserve. He's actually one of my colleagues at the Hoover Institution. Do you have any particular thoughts on this development? And if you met Kevin before, if your potential future colleague pending Senate confirmation?
So I don't know Kevin. I didn't overlap with him at Hoover and didn't overlap with him on the Federal Reserve Board of Governors, but I certainly look forward to getting to know him. But in general, I don't comment on nominees, on candidates for either governor or for chair.
Okay, great. Well, I want to dive a bit into your speech. You talked a lot about disinflation, so I want to talk just a little bit about inflation. So we're still above 2% inflation. CPI year over year is 2.7%. I think core is 2.6%. Where do you see underlying inflation sort of evolve over the next 12 to 24 months? What are the sort of key upside and downside risks to that disinflationary process in your mind?
So typically we look at PCE and inflation. That's our target, and our target is 2% for total.
Oh, is it? I'm sorry.
I'm sorry. So should we repeat what I said about Kevin Warsh?
Okay.
Or not said about?
Sure. Okay. Sure. Please go ahead.
Okay. I'm being facetious. I'll start with inflation. So we typically use the personal consumption expenditures index, which is different from CPI. And as I said in my speech, the last reading was 2.9%, and core PCE was 3%, way above our target. So we are still trying to get back down to target. It's been 5 years. We've all felt the effects of that. So that is our commitment, and that's what we want to get back to. Goods inflation has been the largest source of the inflation that we see right now. So that should be a temporary price rise due to tariff effects, right? But hopefully, it is our hope that the tariff effects are, okay, I'm not going to use the word transitory, but you know what I mean. And I wasn't there when that term was being used. So we hope that they will dissipate quickly. And once they dissipate, we should be in this disinflationary process, back on the disinflationary path. So that's what it will primarily take. We've seen better results, let's say, in housing services. with shelter prices falling over time, but we have to wait for goods price inflation to also wait.
Got it. So I want to talk just a little bit about the labor market. Unemployment's 4.4% right now. It's up off the low of around 3.4%. How tight is the labor market right now in your mind? I mean, you gave this figure, sort of, I think it was the historical pre-COVID average unemployment rate was about 6 point something over the past 50 years prior to COVID.
Right.
Does that mean that the labor market's sort of tight in your mind, or?
Well, I would say that it has stabilized. And again, relative to the 50 years prior to the pandemic, it is tighter, but it is not as tight as it was 2 or 3 years ago. So we've seen it stabilize over 2025. It's been in September of 2025, it was 4.4%. In December, it's 4.4%. There are still risks, though, to the labor market, as I was pointing out in my speech. And one thing we know about the labor market is that it can turn very quickly. If we look at the unemployment data for past recessions, for example, you see it climbing a little bit, and then it becomes exponential. So we really have to watch that very closely.
It's fascinating how it's crept up just over the past couple of years.
Right.
In a very slow way. Usually
very
it goes very fast,
That's right.
When there's a big recession. So
yeah.
It's very interesting. I think there's a lot of people that I think agree with you and sort of argue that full employment, that U-stars come down at some point over some period of the past decade or so.
Right.
I want to talk about the other star, R star. For those that don't know, it's the idea of the neutral rate. It's the rate at which that inflation's neither accelerating or decelerating. Right now, the Fed funds ranges between 3.5% and 3.75%. Is monetary policy, in your mind, currently restrictive, accommodative, or do you think that we're pretty much at neutral?
So I think that we're mildly restrictive. We put a lot of easing into the pipeline at the end of last year. And I think that given where the labor market is, where inflation is, this is the right time to sit back and wait to see what happens. And again, it should be a temporary rise. This rise in the price level should be temporary given the tariffs. So we'd like to see us get back to the disinflationary path. So I think it's mildly restrictive, but ever so mildly restrictive. And I want to wait to see what happens, given what my mentor at Stanford, Milton Friedman, said about long and variable lag. So I appreciate that time and the patience to see what happens with that easing.
Terrific. So you crossed paths with Milton at Stanford?
I did, and he encouraged me to do the research that it's turned out to be my most cited research. Yeah,
on innovation.
Yeah, exactly. Yeah.
I didn't know that.
That's right. Ken Arrow too, actually.
Wow,
yeah.
fantastic.
Yeah.
Two legends in the Stanford economics.
That's right.
And Hoover communities.
That's right.
Just getting back to R-star. I mean, there's a lot of folks that think that R-star has risen in the U.S. and over the past few years. I mean, do you buy that R-star has risen? And if so, I mean, what do you think that some of the main drivers of that might be?
I look through the lens of innovation and AI to understand, because that's what I was studying for 20 years before I came to the Fed, to understand where R-star is. Because one of the factors, as you know, is productivity. Other factors are much more slow-moving, like demographics. So I think of the investment in AI and in innovation as raising R-star as it would, because investment demand goes up, you would see R-star rising. But R-star is a long-run concept. So we can't talk about it really in a 2 or 3 year window as many people have talked about it currently. And for our decisions, it's not as relevant for our day-to-day decisions. It's imprecisely measured, depends on models, surveys, And what we have to be careful about is what happens in the long run and how this moves in the long run. And that's what I'll be looking at. Because like I said, with respect to some demographics, it was a very slow-moving series. So we should watch. We should see whether the short term turns into the long run. But the short run right now, I think, is raising R-star slightly.
Are you a fan at all of model-based R-star estimates like Laubach-Williams and Lubick-Mathis, or are you a fan at all of survey-based estimates? I'm a big fan of the New York Fed survey. They ask just market participants what they think R-star is, even using that median response.
Good.
You think of that as an R-star measure?
Yeah.
Powell recently referred to these sorts of survey-based estimates in the recent FOMC meeting, or do you think of sort of everything all together, all the above?
Okay, John Williams, if you're listening, I'm a real big fan of Laubach-Williams. Real big fan of model-based R-star. Yes. But in all seriousness, before I came to the Fed, I primarily looked at model-based R-star, right? So I would say I have more familiarity with those models, but I find the New York Fed surveys of market participants as being very useful too. And the SEP being useful.
Exactly.
Yeah.
It's interesting because they actually, if you sort of line them up next to each other, they follow each other very closely.
They do.
They're both great measures. FOMC members, their estimates of R-star in the long run, and same with market participants. Terrific. I want to pivot just toward financial stability. It's been about 3 years since the collapse of Silicon Valley Bank. How do you assess risks in the banking system and in financial markets more broadly today? I mean, are there financial stability concerns in your mind that we should be alert to?
Certainly, we are not where we were at the time of SVB. The funding risk is different. The funding risk is lower because of uninsured deposits, the decline in the share of uninsured deposits. So that means that deposits are less runnable. So the probability of a bank run would be lower. And I think that especially for the largest banks, we see more resilience with respect to capital levels. They're at higher levels than we've seen recently, and certainly we're not in the world of the GFC. Right. So I think that there is still a lot to monitor. For example, commercial real estate. We certainly exposed, or SVB, that current exposed a few weaknesses in the banking system, but we're working with our supervisors to continue to monitor what's happening with CRE, and that has stabilized. Certainly. That's a supervisory focus. It remains a supervisory focus.
Fantastic. Yeah, it's amazing how you think today, how a bank run can happen so much more quickly because people like Silicon Valley Bank, they can use their phones to withdraw money. It's not like it's a wonderful life where even though it wasn't a bank, where you have these runs where people have to wait to actually get their money to instantly. Yeah, it's certainly fascinating to have seen that and been near Silicon Valley Bank 3 years ago. I want to pivot to generative AI. You talked a little bit about this in your speech. How do you expect generative AI to affect the labor market, both unemployment and wages? I mean, do you see it as primarily labor augmenting or labor replacing over the next, say, decade or two?
I expect it to be both labor augmenting and labor replacing. But I would argue that we don't have a sense of the sequence of how this will happen, because I think there's going to be a fundamental reorganization of labor, and that will take time. And as I see it now, and what we're learning from surveys, is that this is a complement more than anything else. Say, research that was done at St. Louis Fed, at the New York Fed, we're learning how people are using GenAI, and over half of adults are using GenAI. They're using it more for personal use, which I think is actually a good thing. That means they're experimenting outside the workplace. And when they come into the workplace, I mean, work adoption is around 37%. Personal use is around 49%. So if we can get those to be merged, I think it could be a good thing for adoption. But I've been talking about this for quite a long time and looking forward to the possibilities that could come about as a result of GenAI. But we're very carefully monitoring what will happen with the labor market as well.
That's terrific. I run some surveys myself on, along with colleagues, on asking these questions of people in the U.S. and around the world about, how are they using these sorts of tools?
Mm-hmm.
We find that most people say that they're using large language models and generative AI to help them complete tasks, and that it's not completing their tasks altogether, automating them altogether. So I'm with you there. That I think it's probably more on the labor augmenting side than on the labor replacement side, but probably some degree of both going on.
Can I say just one more thing about that? If we take a step back, I think that AI and GenAI are helping us exploit our comparative advantage as human beings. Because if the possibility is that you can get rid of these tasks in your job that are the most boring ones. In academia, it will be filling out our annual faculty surveys that we have to report about what we did that year. And it's obvious from the web what we've done that year, right? Mm-hmm. So those are tasks that can be done by GenAI or by AI. And I think that's, to me, one of the biggest possibilities, that the real human features, the deep creativity, the deep thinking is what we will be left to do. And we'll see if that happens.
Absolutely. I want to pivot a little bit to stablecoins and crypto. It's Miami, very much likes to think of itself as the crypto sort of capital of the world. There's a lot of questions right now, I think, about the future of stablecoins and crypto, and one big one being whether stablecoins can offer yield. And there's a big fight going on right now between banks and crypto companies trying to influence Congress. The Genius Act passed last year is sort of the first federal regulatory framework for payment stablecoins, requiring full backing and audits. At the same time, Bitcoin's taken a 40% drawdown since the 2025 peak. Any thoughts on the future of crypto and stablecoins and payments in general?
So I absolutely welcome this regulatory framework for digital assets through the Genius Act. And I look forward to the rulemaking that is going on around that. I won't comment on that, but I'm grateful for the regulatory framework. With respect to stablecoins, I think that this is a place where there could be lots of potential related to payment stablecoins. And, I am open to innovation, to financial innovation too. And we have to wait to see the use cases and wait to see how they are adopted. Certainly, there's been much more issuance outside the U.S. than in the U.S. And I look forward to seeing how that market evolves.
Absolutely. It's also interesting that most stablecoin issuance, almost all of it's the USD as well. So it's interesting that there's practically no stablecoins in euros or yen or anything. It's largely dollars. So it's very interesting how it's all evolving. I want to just sort of last topic is fiscal. We've got large and persistent fiscal deficits. And I'm just curious, how should monetary policy think about fiscal monetary interactions? Obviously, the Fed maintains a big balance sheet, and there's been a bit of runoff in recent in the past year or so, but hitting sort of a new level that might be a terminal level for now. I'm just curious, how do you think about the balance sheet? How do you think about any risk of fiscal dominance? Obviously, the U.S. debt's 100% of GDP right now. Raising interest rates, increases interest costs, substantially as you have a bigger stock of debt. I'm just curious how you think about these issues, Fed balance sheet, debt, and fiscal monetary interactions.
So I will just say again that we have a dual mandate that is congressionally given to us, and that's what we maximize. So fiscal policy is the realm of the administration. Congress and debt management is the realm of the Treasury Department. What you don't want with independent monetary policy is maximizing monetary policy to manage the government's debts. So I will stick to my knitting and stay in my lane and try to meet the dual mandate goals rather than figure out fiscal policy. We've got enough to do.
Amen. Amen. And yeah, the 2% inflation target, is key and critical, and getting back to 2. Well, I really want to thank you for coming, Governor Cook. This has been a real honor to have you and for all of us to hear your remarks and for your great answers to our questions here. If everyone could give a round of applause for Governor Cook. Thank you.
Thank you so much. Thank you.